Welcome to All About Money on HKIBC. I am Chloe Fong. 10 days ago, Hong Kong's de facto central bank raised the city's base lending rate by 50 basis points to 1.25%, shortly after the U.S. Federal Reserve increased its rate by half a point. The biggest one-time rate increase by the Hong Kong Monetary Authority in over 2 decades was made despite the city's economic slump, with the local currency under pressure amid a capital outflow. Will a weak Hong Kong dollar affect our daily life and the local economy? Let's ask Wei Yao, Head of Research and Chief Economist for Asia Pacific at Societe Generale. Welcome to the program, Wei.
Yeah, pleasure to be here.
And first, let's go back to the announcement made by the Hong Kong Monetary Authority. On May the 12th, the city's de facto central bank raised its base lending rate by half a percentage point to 1.25%, shortly after the U.S. Federal's decision. Can you first tell us what the rising interest rates mean for the city and what are the reasons for the increases?
Okay, so apparently because Hong Kong is running a fixed FX regime, meaning that it's pegging its currency to the US dollar. And at the same time, Hong Kong has free capital flows. So that means it has to follow the monetary policy of the Fed. In economics, we call it impossible trinity. So they have to do that just to make sure that there will be no excessive capital outflows to overwhelm the FX regime. So the impact on the economy is not going to be positive because higher interest rates means tighter financial conditions. So that's going to be additional headwind to the Hong Kong economy.
Right. And as you just mentioned, the Hong Kong dollar has been pegged to a narrow trading band between 7.75 Hong Kong dollar and 7.85 Hong Kong dollar per US dollar. But when the Hong Kong currency hits the low end of the band, the city's de facto central bank is bound to start buying up the currency to boost its value. And the authority just did it last week, stepping into the currency market for 4 times to buy the Hong Kong dollar, bringing its support to 11.6 billion Hong Kong dollars in total. So I'm just wondering, would the moves made by the authority be enough to defend the currency peg?
This is exactly the mechanism of the currency board, how the HKMA should do in such situation. Obviously, one move may not be enough, but it's certain that if not enough, they will keep doing it. The important thing is we don't think the peg will break. The HKMA has enough capacity, ability, and experience to continue to manage the currency fix.
Right, Wei. And also tell us, besides the currency peg, what are the other factors that may affect Hong Kong dollar to go to the weak end?
So other than the Fed policy, you also have the dynamics of the capital flows that may be related to, for example, the Hong Kong stock market flows, maybe also, the dividend payments. These are the seasonal factors. So, but these things, it happens all the time. It's nothing special, and we have seen, the HKMA always manage these things very, very smoothly. So the biggest factor here is definitely still the Fed policy.
All right, and we know that the Hong Kong Monetary Authority interventions will reduce the aggregate balance, which means the sum of balances in clearing accounts maintained by banks with the Monetary Authority to roughly about 320 billion Hong Kong dollars on May the 18th. And Hong Kong MA Chief Executive Eddie Yue also reassured that there's nothing to worry about. But how long do you think it might take to bolster Hong Kong dollar back to an acceptable exchange rate level? And to what extent or under what kind of circumstances will the Hong Kong dollar rate be bound?
Okay, so actually, the fact that the HKMA also raised the base rate in Hong Kong and potentially will follow the Fed along the way, that automatically also mitigates some of the depreciation pressure on the Hong Kong dollar, a large part actually. And then in addition, if we look at the total FX reserves position of the HKMA, it's still very sufficient. It's still roughly 6 times of the money in circulation. It is still 40% or more of the M3. Indeed, I think when the authority says there's nothing to worry about at the moment, looking at the data, that's indeed the case.
Right. And but following the announcement made by the Hong Kong Monetary Authority, we see that many banks are maintaining their current prime interest rates unchanged. So what do you think are the reasons behind the bank's reluctance to follow suit?
The reason probably is because the weak economic situation condition. Because for the rates to go higher, you not only need the central banks to push it higher, but also you need the demand to catch up. But the Hong Kong economy is just starting to recover from the COVID shock in Q1. And it seems that the credit demand, the investment appetite, even the consumption is still mending, in the process of mending. And so this is probably the fact that the banks are not yet so willing to follow the rate hikes. If the economy continues to recover, if the city can really leave the COVID shock behind us and moving ahead, then the demand will improve and there will be more credit demand and there will be scope actually to raise the rates down the road. So yeah, it comes down to the economy.
All right. And do you foresee the U.S. Federal Reserve will further increase its interest rates in the short term? And what is your forecast on their moves?
Yeah, we do. We do think that the Fed will raise the rates by 50 basis points again in June and again in July. And after that, it depends on the inflation trajectory, it depends on the economic situation. It could be 25, it could be 50. So in total this year, we could see maybe even 200 basis point hike from in total, or maybe even a little bit more.
All right. And following the faster cycle of the interest rate hike, what is your biggest concern at the moment?
The concern is that if the central bank's being overly aggressive, i.e. making a policy mistake, then the chance of stagflation could be rising. The situation is indeed, because of the elevated energy prices, the inflation may not fall very much. Then the central bank has a very difficult job here and very tight rope to walk in terms of whether they continue to fight the inflation or they slow down the tightening for the sake of the economy. At some point, this choice will become even more challenging for them. So the chance of stagflation, the risk of that is definitely there.
And also, we know that the system of the Hong Kong dollar packed with the US dollar has been placed for 4 decades. Do you think this system should continue to be in place in the city? What is your view on this?
I think in the short term or medium term, that still seems to be the best arrangement for Hong Kong as a financial center, also from the stability of Hong Kong's financial system. In the long run, of course, potentially there could be a discussion in terms of how the currency regime could evolve, especially should it be moving more or should it be pegged to the Chinese currency because of the increasing influence of the mainland China economy. But that is a discussion for much, much later.
All right. And following the Hong Kong's economic situation, as we mentioned in the beginning, we know that the Hong Kong SAR has downgraded its full-year forecast for the city's economic growth to 1% to 2% for 2022, from 2% to 2.35%. So when the lower end of the growth range forecast of 2% now becomes the ceiling, so does that spell some kind of a pessimism from the Hong Kong SAR government? And will Hong Kong risk missing the target? Shall we encounter a 6th wave, if we say that?
Not exactly pessimism. I would say, because we already got a pretty bad Q1 reading. That's a fact. So to reflect that fact, of course, you have to revise the full year number, right? Actually, the adjusted number imply that the government expects the economy to see a proper recovery during the remainder time of the year. And that's also our expectation. So the challenge here, yes, as you pointed out, the sixth wave could be one, but also, in terms of, whether Hong Kong can reopen to mainland and whether Hong Kong can finally open a bit more to the world, these are all the factors to consider in terms of how strong the recovery can be from here.
Oh, all right. And I also want to bring out the point about the surging inflation in the city as well. Although it's not that severe at the moment, but how will the surging inflation also affect the local economy? And what do you think that needs to be done to make it under control?
Yeah, the inflation is sort of like a global phenomenon right now. It is very elevated in the US, and the headline is elevated also in your area. And in Asia, also in recent months, we start to see rising inflation, both headline and core. It's going to be very difficult for Hong Kong to avoid that because Hong Kong imports a lot of the consumer goods, well, almost all, a majority of the consumer goods from the rest of the world. And as the prices are rising everywhere, Hong Kong also cannot hide. And the situation then would be, yes, the inflation also going to be another headwind for the recovery. But then you have the rising base rates. Some would also play a function already in terms of tightening credit conditions that could hopefully dampen some of the inflation pressure.
All right. Thank you very much for your time, Wei. Let's take a short break. Coming up next, we'll have more discussions on the Chinese economic analysis, so do stay tuned.